You're on Money Mondays with Jeff, where we talk to dope financial professionals and business owners about wealth building strategies to close the generational wealth gap. Today, we have a special guest, Mr. Chaster Johnson, partner, co founder of Stock Boss Up, which was founded in 2022. It is a stock information platform that is dedicated to getting good information out into the marketplace so more people can participate in this thing that we call stock market investing. So welcome, Chester. How you doing today?
Doing well. I think I'm lagging pretty badly though.
You're lagging pretty badly.
Yeah, I can tell. That's okay.
Well, we're going to have an engaging conversation tonight on this Money Monday, talking about stocks that pays us back. And a lot of people are like stocks that pays us back. What does that really mean? And it's basically when you have an investment strategy of utilizing and investing in stocks that pays dividends. So we want to dive into that a little bit. Talk a little bit about Stock Boss Up and all of the great things that they're doing in the financial education platform and getting and encouraging people to invest in the stock market. So, Chester, tell us a little bit about Stock Boss Up, how you got started, and what motivated you to want to have a financial education platform dedicated to helping people get invested in the stock market.
Well, the big thing about Stock Boss Up that I think is the innovation is anytime someone gives us an idea, anytime someone puts in some kind of stock analysis, we have built algorithms behind the scenes to assess how good that idea is based on that user's content creation history on the platform, how well their ideas have performed. And so, kind of like some other companies on the web, we're trying to figure out a way to give people good stock ideas from the community for each other, kind of separate the financial institutions from making good investment decisions.
But that's awesome, awesome, awesome. I know a lot of people that I've been talking to lately they've been curious. They're not really participating in the stock market. They're just kind of waiting on the sideline, and they hear all of the stock news. They hear on how their friends are making a lot of money with the different stocks that their friends have been purchasing, whether it be Tesla or Alphabet or some of the other more growth oriented stocks. So could you explain to a new investor what's the concept behind dividend investing? Like, what would a new investor need to know to be excited if they wanted to participate and learn more about investing in dividend stocks?
Well, the key is dividend stocks, basically take the earnings that companies make from consumers and other businesses and the government, and they'll give a part of those earnings to the investors. So if you put $100 in, every year you get $6. If you put $100,000 in, you get $6,000 a year. So getting a dividend stock allows you to have an income that is independent of your job, independent of your business, just another source of income to supplement your lifestyle.
So would you say that if a dividend investor, if they buy shares in a stock, they're kind of like an owner?
Not even kind of like, they are the owner of the company. When you buy stock, you're an owner of the company.
So that's the great thing. So then it turns to the company's philosophy now is that they want to make money and ensure that all of their partners or all of their ownership participants are going to be compensated for the money that they've invested in the stock. Would that be something fair to say?
Yes, the stock market is a great equalizer, to be honest with you. You're anonymous. They don't know really who you are, but you can put $100 into a stock, and they'll start giving you a portion of the earnings if they have a dividend.
Okay, cool. So I understand that prior to you getting into Stock Boss Up and being a financial educator, I want to call you a financial educator because you're encouraging people to learn about the stock market so that they can invest in it. So I'm going to give you the tag of financial educator. So prior to that, I understand that you were an aerospace engineer, you were in the management, you did quality inspection. So, how would you apply the principles that you've learned from aerospace engineering and doing quality inspection, working with some of these companies, to the field of selecting like a stock that might be a good um, 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 company to own that can give you some returns on your investment? How did you make that connection?
So, being in aerospace, I was an aerospace engineer when I graduated, but I never used my degree in engineering, unfortunately, or fortunately. I was always a manager from the beginning. I did a management training program. The key thing I learned up front that was very critical to investing was making sure that you had a return on investment. And it really was a calculation that we had to do for every project, for any new production line, whenever we wanted to put in new tools or new machines. What was your return on investment? So it's a simple calculation. It's really look at the cash flow out and the cash flow in, discount it versus a risk rate, and a minimum discounted return that you expect to get. For my first career, it was 15%, and you had to make your money back in 2 years. It was very aggressive. Uh, and if the investment showed to be good, you made the decision to make the investment. And basically, when you build a company or build an aerospace company, each project is an investment that should make a return on the money that's put in.
So, how has technological innovations kind of impacted like your perception or your value of what a stock can perform?
Really, I've seen through analysis that I've done, and you can see my analysis on stockbossof.com. Just look up Chaster as a user, and you'll find what I write about. But you can pretty easily now with data that's open on the web calculate the intrinsic value of a company. And with new technology, you really only in the past you only had really two growth rates. You had a linear growth rate. Think of something like utilities. Think of something like I don't know, like a basic manufacturing stock. And then you had parabolic growth. Maybe a bank would be something like that. Uh, but now with the medical fields and technology stocks, exponential growth is a real thing in terms of the intrinsic value of a stock. And so I think that's really changed the game in the last 30 years in terms of what growth really means. Warren Buffett can't understand that kind of growth, so he doesn't touch it. But he's used to the parabolic growth, the linear growth, while new investors really have even more volatility because these new stocks really have exponential growth with their intrinsic value.
The last little part cut out on you. What was the last little thing that you said?
Sorry, man. I guess it's my internet. I apologize.
It's
The
okay.
intrinsic value of these tech stocks are going up exponentially instead of
Yeah.
parabolically. So it's going really fast upwards.
So since these stocks are going up so fast, right, and everything has been predicated on data, what kind of data driven strategies do you believe are the most effective in not only identifying a stock that pays dividends, but also has the potential to really have a great capital appreciation run. So, like a data driven strategy that's good in identifying what's a good stock that pays dividends and may also have a great appreciation or a great run up in the stock price. What data driven strategies should we be looking at as new investors or investors on the sideline trying to identify a stock?
When you look at stocks, uh, there's some very basic concepts that are very powerful. Um,
Okay.
One that everyone kind of overlooks is the book value of a company. So it's nothing complicated. It's how many assets do they have. You just add up the cash and the cars and the manufacturing plants they own and subtract the debt, right? That's the book value. That really is a powerful metric. It really does showcase real growth in a company, especially a manufacturing company or a bank. And then the flip side is the earnings. Earnings is pretty straightforward. They need to be growing every year. They need to be consistently growing their earnings, uh, and if they can do that, uh, then really it's a simple calculation. It's the book value plus the next 10 years of earnings discounted by the current interest rate, and that's basically the intrinsic value, barring a little bit of adding growth into the earnings over the next 10 years. That's where the price is, and we've seen actually that the price of a stock will go to that value. That is really pushing a stock price up or down ultimately.
So does that apply the same for a company who may not have earnings yet?
We're lagging pretty badly, aren't we?
A little bit. Did you hear the last part of the question? Can you hear me, Chaster?
Can you say that one more time?
It's okay. I said
Try that
um
again, man. I'm sorry. My internet's doing is horrible right now.
it's okay. I mean, it's all good. I was curious to see about the stocks who have not had earnings. So how do you evaluate like companies who may be new to the market or or may have been on the stock market 2 or 3 or 4 years and really haven't had a growth or a earnings model that you just mentioned before? Oh, we lost Chester. Jeff Moore here, Financial Solutions, financial advisor, strategist, cash value life insurance enthusiast. Um, as we wait for Chester to come back on, um, hello.
I am so sorry about this, man. I am the worst when it comes to technology with you, I swear.
I know, right? So,
I'm so sorry about this. I have this new I tried this new thing where I have a cell like I have internet, but it's through Verizon and it's purely just through the cellular, and it's been fine for the last few weeks, but it's been acting up the last few days, and I'm so sorry about this, man.
all right, no problem.
So I unfortunately have to either you got what you got, or we're gonna have to try again some other time. Or we can do it tomorrow if you like. I hate to do it on a Tuesday when it's a Monday thing, but you know.
Okay, we'll try to see if we um circle back. Let me see what I have. Um, let me see if I can schedule something for tomorrow.
I'm just worried about my internet now. I'll try to